Hey guys, Koukun here. In today's video, we're going to talk about VGRO, the Vanguard Growth Asset Allocation Index Fund, and why you should just buy VGRO. Now, before you buy any investment, I consider it very important to fully understand what it is made up of and why it's a good investment, so that in tough times, if the price goes down for any reason, as long as you have an intrinsic understanding of what the investment is, it will hopefully allow you to hold on to it during tough times and potentially even contribute more money to purchase more units at a lower price. So what is VGRO? VGRO is an index fund that is made up of 7 other index funds. 4 of them are equities or stocks, and 3 of them are fixed income or bonds. And it's split between 80% allocated to stocks and 20% to bonds. The 80% that's allocated to stocks is invested in close to 12,500 stocks across the world, and the 20% allocated to bonds is spread out over 17,000 bonds. That is also mainly Canadian and US, but there's also some international bonds in there. So the important things to know about VGRO is that 33% of it is allocated to the US stock market, which is the biggest stock market in the world. So it would make sense that 1/3 is going to the US stock market. And about 24% of VGRO is allocated to the Canadian stock market. So as Canadians, we generally have a home country bias when it comes to investing. That means we tend to overweight our own country's stock market or companies, which 24% is still a reasonable allocation towards it. Another 17% is spread out over the developed countries around the world that is not North America. This includes Japan, the United Kingdom, France, Switzerland, Germany, and quite a few other countries. And approximately another 6% is allocated to what are called emerging markets. So these are countries that are really on their way up, but they're not fully considered developed nations quite yet. A big allocation of that is put towards China, and then there's also some towards India and Brazil. And on the bond side, approximately 11% is allocated to Canadian bonds, and the remaining 9% is split between the US bond market, about 4.5%, and the global bond market, around 3.5%. And one thing to note about the international bonds in VGRO is that they are currency hedged. So that means that you will only get the return of the bond if the currency, so the US dollar or any global currencies increase or decrease in value. That risk has been eliminated so that you get the return as if it was in Canadian dollars. So that's the basics of what VGRO is. I hope that wasn't too confusing. I tried to give enough details so it gives a full picture, but not too much that it gets overwhelming. So let's talk about why VGRO is a good investment. Now, I'm not recommending VGRO as a specific investment to any of you. I'm just saying that this is where I put my own investment dollars, and it's something that you can consider if this is the right investment for you. So the first biggest benefit of VGRO is diversification. By owning close to 12,500 stocks, by owning 17,000 bonds, you are really spreading your risks. So no one company, no one bond can affect your portfolio. So it's really spread out so that you get the overall market return. You're not going to do better than the market, but you're basically not going to do worse than the market either. You're going to get the overall market, and this is the overall global stock market and the global bond market, which is very diversified. Along with that, you're not tied to any specific geographic risk. So for example, Japan has had close to 20 years where their stock market has basically had what's called lost decades, where since I believe the 90s, the stock market crashed quite a bit and it has only just recovered. So it's been like 20-30 years. The US experienced something similar from 2000 up to I think 2012, where the market basically stayed flat during those time periods. So by spreading out your investments across Canada, the US, the different developed nations, the emerging markets, no matter which country does really well, you will get a small piece of that action, but you won't have this incredible spike in any one year, but you're not also going to have a huge decline unless the entire global stock market declines, which has happened, but the risk is a little bit less than if an individual country has that kind of decline. The reason I specifically chose VGRO is that it has an 80% allocation to stocks. I'm a young investor, I have a long time horizon, so I'm willing to add that much equity exposure to my investing. If you're someone with lesser risk tolerance or a shorter time horizon, then it may be worth considering getting a asset allocation index fund. Vanguard offers those as well, with a smaller percentage allocated to stocks. With choosing VGRO, however, there is a 20% bond allocation. If I really wanted to take as much risk as possible, I could go for VEQT, or the Vanguard All Equity Asset Allocation Index Fund. That is 100% stocks. Over the long term, VEQT will actually perform better than VGRO simply because it is 100% invested into the same global stock market. But this is a decision I've made that's a little bit more personal to me than it is specifically investment advice or like, I guess, the best investment decision. It's more the best investment decision for me. Since I did not experience a market decline of 30, 40, 50% with a significant amount of money invested in the stock market, I still don't know how I will feel to experience that. So I don't know how I'm going to react, how my emotions are going to play in that kind of moment. I've decided, okay, I do want to go significantly into the equity side because that's where I feel you can actually get a return of some kind. With bonds right now, the interest rates are so low that it's unknown how well they're going to perform over the next 10, 20 years. However, I've decided to put 20% into bonds so that, if the markets do come down 50%, mine will come down, say, 40%. So it'll just be a little bit of a cushion. And in the back of my mind, I know that within this investment, what happens is whenever one investment performs really well, it starts to sell it off and plow that money back into the investments that are not doing well. So in the case of a market decline, if the stock market comes down 50%, but the bond market basically retains its value, it will start selling the bonds to buy the stocks at the lower and lower prices. Now, the reverse also happens when the stocks do well. When the stocks start to go up, they start selling off the stocks and buying the bonds. So overall, your return is not going to be better than an all equity portfolio. However, it's just going to smoothen out the ride a little bit. And I think it just makes sense for me to do this right now until I've gone through a market decline, a financial crisis of some kind, and experience how I feel having money invested during those times. And then I can decide, you know what, I want to go 100% into equity, or maybe, I'm really not into this volatility. Maybe I go 60% stocks, 40% bonds. So going back to why VGRO, a huge part of this decision is that rebalancing that I just mentioned between the stocks and bonds, but also between the stocks. So for example, if the US market does really well, what happens is it will keep that 33% allocation more or less and sell off any of the excess that it becomes. So if it becomes 35, 37, it'll start selling off the extra and plow that back into the Canadian and the global stocks and into the rest of the portfolio. So that way you don't have one investment that ever becomes a huge chunk of this overall index fund. And by this automatic rebalancing happening just inside the fund, I don't need to actually choose to put more money into one country or another. It's automatically happening within this mechanism. So it essentially is a one decision fund. And what that means is I just need to make the one decision of buying it. And after that, everything just happens internally within this fund, within the portfolio managers at Vanguard. They're the ones selling investments, buying the other to make sure that it meets this criteria that they've set out when they created the fund. And the best part of all of this is that it comes at a very low fee of 0.25% compared to most mutual funds that charge 2 to 3%. So close to 10% of what they charge, which is a huge reduction in fees, while you get all of these benefits of global diversification and rebalancing just built into this investment fund. I consider this a very low risk investment with a long-term time horizon. I don't recommend putting money into this fund if you need it in a year, 2 years, 3 years, even 4 years. I always consider index funds to be longer term investments so that you have time to weather the markets, whether it goes up or down. You have a longer time to allow that to play out. Hope you found this helpful. If you have any questions, feel free to comment below. Give us a thumbs up if you found this video helpful. Until next time, all the best.